All right, yield nerds. Week 1 of January has come and gone, and my theme for the 103rd episode of Yield Nerd is Be Fearful When Others Are Greedy. And the theme, as represented by Dolly, is people stuffing dollar bills into a bag with a storm brewing in front of the stock market behind them. So that is how I feel. You do you. We reached 250 subscribers about 15-ish months into our existence. Thank you for your support. If you're new to the show, I suggest you look at the playlist called Income Investing Roadmap. I start from what I believe is a middle schooler level who is knowledgeable in the economy to a limited extent and start from there and walk them through income investing. That is a journey I myself made about 3.5 years ago. I did not know the first thing about fixed income investing, and I'm sharing the lessons I learned. Having said that, I have no magical powers, and I am often wrong. I thought the debt ceiling drama would have crushed the country, unfortunately, and thankfully it did not happen. So be careful. Don't believe what I say. Do your own research. Well, what is the backdrop of 2024? Some people in the royal blue clothing and the ones in the red clothing are cooking up money in a vat. 2024 is an election year, and that brings very interesting dynamics. People want to show opposition to each other. However, one party wants to show results and the other party wants to show it's their recipe. And so there's a little bit of an interesting dynamic. There still is the threat of a shutdown. It may happen. It may not affect the stock market, but if we get to April 30th and we reach the cliff where there is a 1% cut from 2020, watch out. That will bite very, very hard. So having said all of that, both parties need to come together with very slim majorities, and there actually will need to be bipartisanship in the next 3 months, and I hope it happens. In the meanwhile, the market appears to ignore all of this. The market appears to pray for 5 rate cuts in 2024. Good luck with that. Bitcoin is now an ETF, and Mama's Casino is going to be the next ETF. I don't mean to make fun of Bitcoin. If you own it, good for you. I want nothing to do with it. And price to earnings ratio is also at an all-time high for growth stocks. Not my cup of tea, as you know, if you watched my show before. The soft landing seems to be the theme. So everybody is jumping into stocks at crazy high prices, in my opinion. I guess I can't tell them they are wrong. I've been wrong many times. So all I would say is let's wait and see. My slowpoke boring portfolio in the meanwhile is barely registering a tick in this year. It's only up a minuscule 0.25%. Having said that, if you go to the last 6 months, you kind of see how it is up approximately 3.5% in the last 6 months. On an annualized basis, close to 7% state tax free. And in Illinois, state tax is about 6.25%. So you guess it's around 7.5, something like that. About 90% of my portfolio is fixed income. So I am more on the extreme on fixed income. I am buying equities, but I'm being very, very cautious about when I buy and what I buy. I am going to discuss some specific equities and specific trades. I want to make sure you understand I'm not here to sell you anything. I couldn't care less whether you buy or don't buy. As a matter of fact, if you disagree, I want to hear from you with greater interest because I can learn from you as much as you may learn a thing or two from me. I have no snake oil to sell. So here is a deep dive on my portfolio, and these images are from Schwab, and as you can see, I am 90.6% into fixed income. I am very, very heavy into it. And in the little 9% on stocks, I am also extremely lopsided on US stocks, so I don't really own too many international stocks. And if you look at my asset class, and this really is where the rubber meets the road. It's not often the quote genius who picks the correct stock, but it's asset allocation and asset classes. Let me tell you what I mean by that. As you can see, I am 90% in fixed income. What Schwab shows as cash is really T-bills. T-bills are not counted as fixed income in Schwab's mind because it's very short-term cash. So that's my 90% in fixed income. As you can see, in international equity, I barely have anything. In large cap, I barely have anything. And those two are a factor of pricing. If I can't find stocks that meet my filters, and we'll talk more about what my filters are, and if you have not yet watched it, I would suggest the previous episode does a deep dive on the filters. Small cap is really where most of my equity holdings are, and that is my asset class allocation within fixed income. You can see again, I have a tremendous concentration in treasuries. I do have bank loans and FRNs. There are a couple of ETFs there that I own. That is what gives me dividend income, and the interest income come from these bonds, which register as gains, not really income. So what does that do? As you can tell here, the green rectangle is me. In the array of risk, if number one is the high stakes, extremely aggressive person who buys Bitcoin, whatever else they buy, they walked away with 21% returns, my hat's off to you. That is very high risk, not my cup of tea. The extremely low risk person, I suppose, would buy FTSE, and they would sit there on 3-month bills and they barely made 2% returns. My portfolio, according to Schwab, made an 8% return. And this includes money that was taken out, money that was put in. And so, I did take some money out to pay estimated taxes, to pay some household expenses, that sort of thing. So this computes the percentage of the work that the money that remained in the system did, which, this is all of last year, 1/1/2023 to 12/31. The reason I'm showing this to you is for me to share how my fixed income experience is. And if you have better ideas, I'm all ears. If you give me 8% returns with very low risk, I would eat it all day long. And that is just my style, and you do you. So let's look at asset classes, and there is a scorecard that you get within Schwab. And here is what it does. Whenever I buy large cap equity, I make sure it meets my filter, otherwise I do not buy it. Clearly, the S&P has delivered double the performance of my large caps, and as you may remember, my large caps are less than 1% of my holdings. And so the good value large caps are not really showing tremendous improvement, in my opinion. It's the growth stocks that are large caps that are showing huge, returns, and that's up to you if you want to own them. Having said that, you can see my small cap, which is where most of my equity is absolutely hitting the ball out of the park. It delivers double what the Russell delivers, and I'm very happy to see that, and I would like to think that has something to do with the quality of my filters. Internationally, again, less than 0.5% of my holdings. If I don't find good value, I generally don't go look for it. And so I don't do well compared to the international benchmark, but it doesn't really bite me because I don't have too much there. Fixed income, my returns are double that of the aggregate bond. I do own several agency bonds, and those give even higher returns. So that's probably what is biasing me better. And cash is all T-bills, and as you know, T-bills do return very, very good numbers these days, and that's why it's showing that. So last year was a very good year for me, and overall it gave 8% as you saw, and the returns were delivered, I would imagine, mostly by fixed income, cash investment, and small cap equity using the filters. So I clearly am biased towards small cap, and I'm doing well there. Large cap, I am losing. So, maybe I should rethink my opinions on large cap, and I can be convinced if the fundamentals change. I am not a person who chases dreams and rumors. So show me solid fundamentals at a good price, and I will buy more large cap is my philosophy. Here are the screeners that I use. And if you want more detail on these, please watch the previous episode and you can see me walk through each and every one of them. I have a very firm belief on the earnings cycle and how a company uses cash. And that is why I allocate the cash the way I do. And I again reviewed this in detail in the previous episode, so I'm going to go through it very quickly and make a simple point. If a company makes cash through operations, they can use it in many different ways, one of which is to pay debt, the other is to buy stock, the other is to pay dividends, or they can sit on a pile of cash or put it back into their operations. The challenge really happens is when you look at a cash machine like this, how much are you willing to pay for $1 in earnings? If you are willing to pay $1 in earnings per share for $1 of earnings, I would say that's a phenomenal purchase. Frankly, the company at that point is giving the house away, because then you might as well buy the whole company. But somewhere between $1 and $35, where you're willing to sit around for 35 years to get your money back, is sanity. And I have a hard and fast rule. You give me a P ratio greater than 20, I say no thank you. And that is part of the reason why the large caps are not meeting my criteria to great extent. Here are my winners, and these are ones that have delivered double-digit returns for me. And these may not be good buys for you today, only because I've owned them for a long time. And by owning them for a long time, I get to enjoy 120% improvement in price. And just by virtue of saying that, their PE ratios will no longer be good. I bought them when their PE ratios are low, and as their price goes up, their market cap goes up, and so does their PE ratio. At some point, I'll think about exiting these, but I have no interest in exiting any of them right now. But as you can see, a large number of them are food and energy. TK Tankers is a fairly new one I talked about in the previous episode as well. And just to keep things consistent, so you know that I practice what I preach. And for the record, I don't preach what you should do. I share what I learn. Most of my trades in the last 10 days since the previous episode have been agency bonds being called, which I'm very sad about. As you can see, these are beautiful interest rates, 6.7% rates, and they are getting called. I do own a very large number of small ticket item treasuries that keep maturing over and over again, and they are getting matured. Here and there, here is Pioneer Energy, here is TK Tankers, Cord Energy. These are all things that meet my filters. And more tankers, more Pioneer, more Pioneer. Outside of that, it's just a whole slew of treasuries coming in and out, and there is a reason why I say this. There is an infamous statement, credit is given to Vladimir Lenin, that says there are decades where nothing happens and weeks where decades happen. The point in all of this is we can sit here and say, gee, I want to be, a little fidgety and go buy this and go buy this flash in the pan and go buy that flash in the pan. That is not me. You do you. I patiently wait for the right moment to go from fixed income to equities, which I do intend to do at the right time to a greater degree. But for now, I am still T-billing and chilling. I do believe the country as a whole, investors as a whole, are vastly underestimating the potential dangers of some geopolitical tensions that are there. There is a two-party collaboration issue that also has a problem. And this soft landing, I want to see it, but given the geopolitical risks and the two-party risk, the soft landing may or may not actually materialize. And so, given all of that, I am going to sit on the sidelines, play with treasuries, buy only if my filters click. Otherwise, this is yet another week where not much happens, and I'm happy to sit on the sidelines. Thank you for listening to Yield Nerd.